Good morning, everyone, and welcome to this session on European Opportunities Trust. We're joined by Alexander Darwall, who's manager of the trust since the year 2000. Alexander has applied the same consistent approach since then, with a concentrated portfolio and a strong focus on all-weather global businesses listed in Europe. The trust published its interim results to the 30th November recently, a period which was relatively challenging. That said, it's worth noting Alexander's long-term track record of outperformance, in which JEO, which is European Opportunity Trust, has only underperformed its benchmark in 3 of the last 19 financial years. Before I hand over to Alexander, a small amount of housekeeping. We've have about 20 minutes for the formal presentation, with 15 or 20 minutes available for questions afterwards. Your microphones are muted, but you can ask questions by using the Q&A function, which you should be able to see at the bottom of your screen. And I'll put your questions to the manager at the end of the session. So please do make use of that function. There are quite a number of people attending the session, so please don't be too disappointed if we don't answer your question. All questions will be shared with the manager, and we'll do our best to get answers back to everyone if we don't touch on a topic during the session. So without further ado, Alexander.
Thank you very much. I will tell you what we're going to talk about this morning. I'm going to talk a bit about the new company here, Devon. We've been going for about 18 months. We're going to talk about our investment process, what we look for in companies, what our investment offer is, what you can expect from us. But I'll just draw your attention to this first slide. Indeed, it has been a challenging time recently. Patience is a virtue at all times, but particularly as regards this trust. We've had these rocky patches before, and with due patience and with good quality analysis, I am confident we can come through as we have done in the past. So I'm going to turn to just talking a moment about Devon, our company. Luke and myself and Richard Pavry worked together at Jupiter for many, many years, and we decided to leave and set up Devon Equity Management. We are based in Victoria Street in London, right opposite our old offices, and indeed we tried to replicate everything we had there before, so that the things that have made it a successful strategy can be replicated. We can make it a successful strategy again. So we have a very experienced chairman of our company, Simon Troughton, who was formerly chairman, amongst other things, of Aberdeen Asset Management. We have very strong compliance and oversight functions, we have strong dealing functions, and we have all the back office we need. So we've got the resources to compete and succeed. And we wanted, as I say, to get all the good things that we had before and to build on that. And we think we've got a decent stab of making things better than we had before. And if we look at the team, just the core of the investment team, Luke and myself, and we've hired Charlie Southern, who is, amongst other things, very experienced in Asian and technology investment. And that's important for us because much of what we're doing is great European companies that succeed on the world stage. So having that strong analysis and experience from what's made what it takes to be successful in Asia and in technology is really important to us. We have other hires coming, so I can confidently say I'm going to have more resource here, a more good quality resource here than I had formerly. So that's a really good base for us. Just moving on to the investment offer, and I'm going to spend a bit of time on this because it's the most important slide. I'll just pick out a few of these things. We invest in companies, not stocks. And that's a way of saying we're real world investors, and I'll come to more of that. And it's a way also of saying that we're not bound by herd mentality and by what everyone else is doing. We really do think for ourselves. And that is one of the key things that's driven performance over the long term. So it's companies, not stocks. It's a whole mindset. And if you like, it's kind of a private equity mindset, because we really need to believe in businesses before we commit, not thinking, well, we can just sell the stock the next day. We can always do that, but it's better to have a disciplined, good quality risk entry into investment into a company. We're always looking for structural winners, not just cyclical winners. It's about winners through the cycle. So we take the timing element out of it. And we're always looking for differentiated, exceptional companies. In a sense, what we're looking for is to provide you with a portfolio of exceptions to the rule. And exceptions to the rule means that whereas in the normal course of events, a company with high growth and high margins should have those margins and opportunities eroded either by a regulator or by competition. We're trying to find those situations where either the regulator is not interested, well, and the competition can't compete easily. So we're looking for companies who have, if in a sense, an unfair advantage. And we can find these across many, many sectors. Underpinning what we do is the phrase I used earlier of good quality risk. And that means, amongst other things, that we have multiple protections in the business, a lot of flexibility, and multiple upside options for growth. And I'm going to use in this presentation a couple of names of our investment. There's nothing particularly important about these names. I'm not making any stock tips. I'm just saying it's a fact that they are big holdings for us, which are Novo Nordisk and Dassault Systèmes. Novo Nordisk we've owned for about 12 years. It's the world leader in the treatment of diabetes, and they do it through insulin and other drugs. And Dassault Systèmes we've owned since 1996, and it is a world leader in computer-aided design and computer-aided manufacture. But both of them will illustrate points I make about what we look for in companies and where we see these patterns emerging. So I'm going to use those two companies as an example through this presentation of what we're doing. But if we look in terms just of, first of all, of multiple options for growth, both of them can illustrate that. In the case of Dassault Systèmes, you take world-leading CAD/CAM from their historic business, which is aerospace and automotive, which is very manufacturing, engineering driven, and you take it into new fields. And one of those new fields is healthcare, where they are already demonstrating that they're going to be a winner. So that's a way of saying it's one of their many options for growth, but we see options for growth with both Novo and Dassault in the case of Novo Nordisk, new drugs, new geographies, comorbidities, new indications. This is part of what I call good quality risk. We avoid simple binary outcomes where you might say, I don't know, the Brexit referendum mattered a lot. It made no difference to what we were doing in our portfolio because the kind of companies we invest in don't have those very big binary moments. They're a series of global options for growth. If I just move on to the investment process, I want to highlight just two things in here. One is on idea generation, identifying patterns and triggers. We look for the same things with all our companies. And I have it in a few slides' time, you'll see it. Though I'm not going to speak to every slide, you have it in the pack. But we look for companies which are both independent, they have pricing power, they're not unduly dependent on third parties. And I look for these patterns across many different sectors, but always companies which tend to have high IP, intellectual property, control their own destiny as far as reasonably possible. They tend to compete internationally, and so they're not dependent on any one particular economy. Again, that's a very important thing from a risk point of view. So these patterns we look for in many different sectors. So we have a lot of diversification in the portfolio, but we have a common pattern in each case. Companies, as I say, independent, strong IP, strong points of differentiation, and an ability to monetize what they do. And the other piece of the investment process I want to highlight just on this slide is total market coverage. We're investors, not sector specialists. And that means that we look at all areas of the market. We may not invest in all areas of the market, but we really like looking at different companies to see if there's something we can learn which has a relevance elsewhere. And where we can make those connections, we're in a better position to understand. I mentioned Dassault Systèmes earlier. They are a world leader coming from automotive and aerospace in CAD/CAM. But when they moved into healthcare, because we also follow healthcare, we were able to check what they do and the validity of their claims with customers in the healthcare sector. It's just one example where being able to look at what makes successful investments across the total market gives us an advantage. So that's what we do, total market coverage. I'm going to move on from the stock selection process, and just because we're not going to have time to go through every single slide, and just pause briefly on the right company and the right pattern. Here are some of the good things I talked about earlier. And again, it's underpinned by a mentality of good quality risk. If we have companies that can operate independently and don't depend unduly on particular suppliers or particular licenses, that is a strength in terms of risk management. We like companies with good intellectual property and less capex. And I'm going to pick up on that point in a minute, because our companies tend to have less debt than the average. Again, where you have companies, less debt, less dependence, more visible and recurrent demand, this for me is good quality risk. I'm going to talk about some of the challenges I see in the market at the moment. The COVID one is obvious, and maybe there are going to be some questions, so I'll cover that in questions. But I wanted to talk really just about the debt, because with the challenges of COVID and the fact that interest rates are currently very low, we have an explosion of debt. I think this is very dangerous, and I'm pleased to say that we are keeping discipline on this point. Gearing in the investment trust is as low as it's ever been. It's very, very low. I think it's of the order of 3% presently. That is important. And allied with that, our companies have better debt levels than the average. We need to maintain this discipline, because people have become complacent about levels of debt and low inflation and low interest rates. I think, and I refer to it in the EU Green Deal, which I'll come on to in a second, there will be cost inflation, at which point interest rates will have to go up. And then I'm glad we've got less debt, and we've got companies with high recurrent visible cash flows. That is going to be a really important element of what we do. So just looking at the balance sheets, this illustrates that we have better interest cover and lower debt than the average in the market. And I'm very comfortable with that prudent position, because above all, what we're trying to do is to find companies and offer you a portfolio for all seasons. So I don't want to have companies which depend on a particular macroeconomic scenario. That's to say, we have not built the portfolio on the basis that we have free money forever with debt. We built it on the basis that interest rates might go up, they might come down, but we're going to stick with strong companies, a fund for all seasons. If we just look at why we have this global approach, Europe lags the world. The COVID crisis has not been good to Europe. The charts, if you look recently, have been very interesting. All the furlough money and government support in the West essentially has gone to fund huge trade surpluses from Asia. We've been buying consumer goods at a tremendous rate. And this has been tremendous for Asian exporters to the West. It's left us with a big debt problem, but it's been great for those exporters. And our fund taps into those kind of growth opportunities we find across the world. And again, it is part of better quality risk by being more diversified geographically, because Europe is not the only answer. We can prove this sort of point, or show this point, by showing that for the first time recently our fund became with look-through sales, all European listed companies, but we've got more in North American sales now than we do in European sales. And again, a strong showing from Asia. This, I believe, shows a very, very well balanced portfolio, albeit one with a label of European companies, because what we try to do is to get great European companies that compete and succeed on the world stage. I'm going to spend just a moment on the Great Leap Forward, which is the otherwise known as the EU Green Deal, which is basically Europe and the UK's strategies. And I think it's important because, again, it plays to the fact that we want to have global winners, because a dependence on Europe, I think, is dangerous. The European Commission, which has had various things like the Lisbon Strategy for 2010 and Europe 2020, has failed to deliver the growth they promised. And I'm concerned that things like the EU Green Deal, which will raise energy costs significantly, We just need to be aware that a significant increase in energy costs will have inflationary consequences. So again, we positioned ourselves, I believe, in a prudent way to deal with those eventualities. So this just gives you a flavour of how we position. Stronger balance sheets, less exposure to rising energy costs, which is a concern, and as I say, the global less debt and a more global exposure, mitigating regional risks. I'm going to pass over the next few just on ESG and corporate governance. I mean, just to summarize what I'm saying on that is, this is vital to what we do, but not in the formulaic box-ticking sense. It's always been integrated into what we do, and it is inextricably linked to the broader investment process, that we have to have companies with good corporate governance. We have to have companies that treat their workforce well. We have to have companies that have good quality products. Novo Nordisk and Dassault Systèmes could not have succeeded as they have and continue to succeed without those good practices in place. So it has a new label, and we all get excited about the new label, but company culture has always been a vital ingredient of what we do. And we have it integrated in our process, and we have an investment committee oversight, and we have the involvement of our chairman to check that our companies are duly selling good product, authentically produced, and the solutions are, as I say, authentic. We cannot succeed without good quality companies, and this is integral to good quality companies. I'm going to move on to investment themes. Again, it might fuel some questions on your side, but I call them special foods, which is a slightly strange way of explaining it perhaps, but this will be the first category. We have categories, again, of what I would regard as exceptional companies, the exception to the rule. Genus is a UK quoted company, but a global winner in genetics for pigs and beef. Plenty of demand for what they do. Again, a play on greater efficiency in agriculture. Barry Callebaut is the world leader in the provision of chocolate. You won't eat chocolate for any length of time or on more than one or two occasions without it ultimately having come from Barry Callebaut. They have about a 40% world market share. They're the most vertically integrated, the best at what they do. Movi is a salmon farming company. Again, it's vertically integrated and is the best in their sector. And in terms of protein production, it's a very efficient way of delivering protein to the world, and strong demand continues. I'll just summarize some of the other categories. Alternative finance, we're not in mainstream banks. I see plenty of opportunities for what I call these alternative finance. We know these companies well. There are plenty of good opportunities here. In digital technologies, well, digital is everywhere, and every company that's going to succeed has to have a credible digital strategy. But the ones I've listed here are very close to the digital ideas and have ways of succeeding. Healthcare is very topical because of COVID, but these three companies I've listed, Novo Nordisk, bioMérieux, and Grifols, I believe have structural drivers which go way beyond COVID. Novo Nordisk, as I mentioned earlier, it's a world leader in the treatment of diabetes, which continues to grow throughout the world, and the comorbidities like cardiovascular problems and obesity problems. Novo Nordisk treats all of those, and I think those options for growth will become much more evident with them. bioMérieux is a world-leading diagnostics company, and one other thing, it's not simply that COVID matters in terms of diagnostics. Reducing the use of antibiotics is a critical health target, and to do that you need better quality diagnostics. So there is a strong secular trend. And with Grifols, which with its blood plasma fractionation businesses treats all sorts of diseases, mainly neurological, but not only, with albumin and other IV proteins, the outlook is pretty good. So just coming to the concluding slide, I believe we're positioned to meet new challenges, debt and different levels of growth around the world. We're very consistent in what we do. We identify Europe's global winners. And we mitigate risk by doing these things, by having lower levels of debt, better quality companies, and by sticking to what's made this strategy successful. And we stick to that by replicating in our new company the things that made us successful in the old company, and by continuing investment strategy, which has been proven over 20 years. And I think this is why we can approach the confidence with the future, indeed, with some confidence. So thank you for your attention. And with that, I'd love to take some questions, please.
Thank you, Alexander. Very kind. We've got a number of questions, and I'm sure if anyone else has any other questions, then please do put that into the text box at the bottom right-hand side. Alexander, just first question, we've had a couple of questions on Wirecard. Obviously, you mentioned that you focus on companies rather than stocks. I don't know whether that has any relevance to Wirecard, but if you maybe you could just explain the Wirecard saga, possibly, or I don't know how to explain that.
Okay, thank you. So on Wirecard, I mean, the most important thing to say on this is clearly I made a huge mistake here. This is entirely my mistake, and it is a very serious mistake. I don't exactly know what's gone wrong, and it may be some time before we know exactly what's gone wrong, but clearly there was massive fraud there. I didn't spot that fraud. I didn't believe, because the auditors and the regulator, the German regulator BaFin, raised no concerns. I had undue confidence in them. I had undue confidence in a management team, believing that the fact that some of them were honest, and I was confident some of them were honest, that was any kind of safeguard. So it came up as a very profound shock. And I had to recognize that as a very serious mistake. But I would just go on to say that if you think of the Mike Tyson quote, everyone has a plan until they're punched in the mouth. Well, we've certainly taken a big blow with Wirecard, but we still have a plan. And really the test we've had is, after a serious error like that, can we continue to have a plan to invest in the way we've done and to invest successfully and not retreat into the comfort of being a closet index tracker? Well, I think over the last year we've demonstrated clearly that is the case. We are still confident in the investment process, and we will keep going.
Excellent. I don't know whether you've got any stats in the back of the presentation, but I don't know whether it'll be a tricky question to answer, possibly, if you don't have it. But we've had a few questions about how does the underlying portfolio look in terms of valuations, growth, etc., relative to the benchmark.
Okay, look, for this, I'm going to ask Luca to join us. Luca has all the stats with him, so we're going to, you will see him in just a moment. And then, Luca, I'd love you to talk about that. While he's just preparing that, we have already provided stats just on net debt EBITDA. So we know we've got lower debt levels. And just as Luca finds these numbers, some of which may be in the appendix, we have had higher Ps consistently, but they are always short-term Ps. Look at Novo Nordisk and Dassault Systèmes. It's not just that they've been re-rated with higher Ps, it's the fact that the earnings performance has been, over medium and longer term, much better than expected. So we're very comfortable with short-term Ps, but only where and only if we are confident that growth rates can be sustained at higher levels for longer. So with that, Luca is going to come and give you some numbers.
Thank you.
Must want to move slightly, I don't know.
So to answer the question, for example, on the forward PE of the fund, as usual, this is based on the weighted harmonic average. The portfolio is on a higher P than the index of 24 times versus 16 times approximately for the benchmark. And that's been the case for a long time. I mean, for example, in the case of both Novo Nordisk and Dassault Systèmes, they have consistently had earnings expectations much higher than the benchmark which they have achieved. And in fact, if you go back till 2001, you will find that Novo Nordisk was trading on a PE of 30 times, for example. So I hope that's answered the question. I think it does.
Thank you. There's a few questions that can be loosely grouped in the sort of investment trusts. What are the tools that you use that investment trusts enable? And including, I'm sort of grouping gearing, and maybe you could talk about which is one of the tools that potentially adds to investment trusts advantages. If you could talk about your approach to gearing as well over the cycle.
Thank you. Gearing, you're absolutely right, is one of the important tools in an investment trust. I think investment trusts are the highest form of investment life, and we can do things which you can't do in a pure UCITS environment. But that doesn't mean to say that we should be gearing all the time. I've not moved gearing around very much historically, but I just think with debt levels at the moment and with markets embracing, I think, quite a lot of optimism, I'm reluctant to have too much gearing. So we are at low levels of gearing. In the event of a little bit more realism coming into the market, I could imagine increasing gearing, but we'd have to, so we could do that, and I would discuss that with the board, but that would only happen if we make the case for it. And at the moment, it seems to me we're in a bit of a phony war. That's to say, the governments are racking up vast amounts of debt, and everyone feels pretty happy about that. What is actually going to unfold in the economies of Europe is less obvious when we come off the life support machine. And so I think I just want to see what the economic consequences are, whether we get inflation, whether we have a very severe recession. Let's just wait and see. It might be that in the future, it's more appropriate to have some more gearing, and gearing has added to returns over a long period of time. So the tool is very good, but I don't think now is the time to use too much gearing.
To give a bit of perspective, historically, the average since the year 2000 has been just under 15% gearing. And as Alexander mentioned, the gearing is just under 3% at the moment.
Thank you. And just another potential advantage of an investment trust is that you can have a relatively concentrated portfolio, and that's sort of one of the questions. You know, I think one of the questions was that you've got I think 50% of the trust in 6 companies. I don't know whether that statistic's correct, but what's your view on, or how do you build the portfolio and have such concentrated positions?
Yeah, I like concentrated portfolio. We have plenty of diversity within a portfolio, even a concentrated portfolio. In fact, you could say that whereas I think we've got about 33 holdings, I think, at present, you could find a portfolio with 133 holdings and they've got less diversification than we do. And that's because our companies tend to be single company ideas as opposed to systemic thinking where you might buy lots of capital goods producers or lots of dollar plays or lots of oil companies. We don't think like that. We're much more targeted. So as a result, it's not the number of companies which gives you diversification necessarily. It's how spread those different activities are across the whole piece. So we have plenty of diversification and we have plenty of geographic diversification. So I'm less bothered in a risk sense by the sheer number of holdings. I'm more worried about what they do, the fact they're uncorrelated, they're covering lots of geographies and lots of different activities. And again, good quality risk knowing that they've got recurring demand and so forth, is more important, I believe, in terms of real risk than it is just having a lot of different company names, a lot of different holdings. So I'm perfectly happy with concentration. But I'd have to say, we're being very consistent. It's what we've always done, and there's no real difference in the level of concentration now to former times.
One very good question, which I hope I haven't lost here. Here we go. I'll read out verbatim. There's a lot of pessimism around European economic prospects versus other regions. Why should I invest in a Europe-focused investment trust rather than a global or other regional investment trust?
Well, I had a stab at answering that earlier, but I think there's no doubt that Europe's got some great world-leading companies. There are companies in Europe that are the best in the world at what they do. There's no question about that. And we have a lot of those companies. And I think the questioner is absolutely right. This is not a play on European economic performance. I mean, if it was, we would have lost a lot of money since 2000. In 2000, the European Commission said that as part of their 10-year Lisbon 2010 strategy, they would make Europe the most productive place on earth. Well, they spectacularly failed, and they failed again for the next 10 years, and doubtless they'll fail again for the next 10. And yet, our companies have performed well, and yet you as investors have made a lot of money. I mean, if you look at that first chart, look where we come from, and the returns, again, Luke is better on the numbers than I. I mean, we can see that the returns since 2000 illustrates my point. We have had a massive increase in value in this trust since 2000, whilst the political agenda in Europe has not produced the growth levels they promised. So I think that illustrates that by great European companies that compete and succeed on the world stage, you can do very well.
I think also, if we use the examples of Novo Nordisk and Dassault Systèmes, Novo Nordisk was generating the majority of its returns in Europe back in 2003, and they have found that that global growth for us, and it has been largely in America, where they now derive about half of their sales. And as you would imagine, they are now increasing their exposure, in Asia. In fact, if you actually look at the reporting of a company like Novo Nordisk, they include Europe as an afterthought. They define it under the international section of their sales, which I think tells you, in terms of mindset, that the real excitement is further afield. And it's very much the same picture in the case of Dassault Systèmes. So when we find a company with something a little bit special, it's good to travel with them abroad.
Thank you. Just a question on ESG, and obviously everyone's view on ESG is entirely different. But there's a question on Maui. I hope I pronounced that correctly.
Yeah.
Obviously, it produces very cheap protein, but there is a question about its sort of sustainability in terms of the environmental damage that it may or may not cause alongside producing that cheap protein. So is that something you consider?
Yeah, no, it's a very good question. So actually, I just want to say, just on the ESG thing, we work for you. We work for investors, and our job is to try and make money for you, and we do it by investing in what we believe are really great companies, and we tend to make money with a mindset, as I say, companies, not stocks, over the medium long term. That's what we've always done. But have it be absolutely clear, we are here to serve our investors, not any political agenda. There's a massive difference in that. So we obey the law, and we expect all our companies to obey the law, but we're not going to address or change what we do for any particular investor in our trust. We can't do that because everyone has different views. So we keep it simple, and we'll try and make you money. So turning specifically to Movi, there are a lot, and rightly so, of regulations and laws about what they can and can't do. It is a heavily regulated sector. And in that context, I think this is an acceptable investment. I mean, what I think personally about it, in a sense, doesn't matter. What matters is that this is a legal enterprise which obeys the law and obeys the regulations. And I think it's not really appropriate for us to try and change that thing. It's more appropriate for politicians to change the rules. But just so you know, in a place like Norway, where Movi comes from, they use no antibiotics at all. And I think it's important to recognize that their interests are very closely aligned with consumers' interests. They need to have authentic product. They need to be strong on environmental concerns, and they endeavor to do that. But above all, it is their duty and obligation to follow the rules and regulations, and that's what they're guided by. And for as long as they follow rules and regulations and are a legal enterprise, I think, and quoted, I think they're an acceptable investment.
Thank you. One of the questions is on the discount, and it's perhaps a bit topical given the recent interims, but your discount has appeared to widen out over the past year to about 10%. Will you, I suppose the board will be taking any steps to address that discount?
Yeah, I'm never the best person to talk to about discount because it's a board decision, but the board has, and we're shortly going to be publishing the report accounts. So I got to be careful I don't tell you what's in there if it's not something that's already known, but what I can assure you is the board is very interested in discount management, and I think I'm able to say that, you know, we announce regularly share buybacks and will continue to do so. I would just add my personal view on this is that there have been many times over the years where I've met people who say they'd love to invest, but they can never get it at a discount, where you can get it at a discount.
Thank you. Just to cover this up, a short question, but is growing the dividend yield important to you?
This is a board matter, not mine, but as a major shareholder, I'll give you my view on it. I think with tax on capital gains so much lower than income tax, personally, and I speak as a shareholder in JEO, I would personally rather have the opportunity to take income such as I wanted by crystallizing a capital gains tax than I would an income tax. But I am only one of many investors, so this is a board matter, not mine. But the I don't know if it's the Articles of Association, but our purpose is above all capital growth. That is the purpose of the trust. So it would not make sense to have a capital growth trust which also aims to pay out silly amounts of dividend.
Thank you. Value versus growth. Do you have a particular preference for either? And do you see that the sort of value rally that we've had, or we seem to have value rallies regularly?
I always struggle with the distinctions. You know, we're trying to create value by investing in great companies which tend to grow. So I'm very reluctant to talk in a very sort of binary way about value or growth. A lot of so-called value investors who've underperformed over 5 years have said, well, what do you expect with value investors? And I don't find that satisfactory. I wouldn't be making those kind of excuses. But I think it's better I tell you what we do. We're trying to find companies which can grow, there's a clue in the name, I suppose, that word, that can grow longer and stronger than the market expects, or i.e. than the valuation would imply. So in that sense, you could, if really pushed, you would be right to say we are looking for top line growth, but we're looking at growth to generate value.
Fantastic, thank you. What's your personal stake in JEO?
That's a really good question. Do you know, I don't quite know because I don't spend much time counting it, but I have, and I'm not on the board of JEO, so I don't have to disclose it. But what I can tell you is, it's from my point of view a very significant. It's all my savings effectively. Sorry, I don't know if that's sort of. I honestly don't know, but it's millions of shares rather than less than that.
And then just on the concentrated portfolio part, do you have a limit on the percentage of the portfolio at any one company?
We have two limits. One is no company would be more than 20% of the portfolio. And the second limit, and Luke will correct me if I got any piece of this wrong, but the second limit will be any holding that is more than 10%, we wouldn't buy any shares in that holding. But if through its own performance it went to 11% from 10%, that would be fine. But we review this with the board frequently. But the hardest limit is 20. But I think our largest holding at present, I think, is of the order of 11%, which is Novo Nordisk, and our second biggest is just under 10%. You won't be surprised if that's how it is today. That's how you can reasonably expect it's going to be for some time to come. It's unlikely that the current look at the portfolio is going to change in terms of concentration very much.
Thank you. I hope you don't mind me saying this, but a sharp-eyed reader has said that in the report and accounts, it says you've got a 3.3% holding in JEO. So
well, that's fine. I don't know where they necessarily. Yes, I'm personally not obliged to reveal because I'm not on the board. So I don't know what regulatory authorities do that. But thank you.
And then really a last question, which I don't know whether there's a right answer to this, but do you, given that you don't really, maybe I'm leading the question, but given that you don't pay much attention to the makeup of the benchmark, do you expect to outperform every year?
That's not a question I've asked myself before, but I think, gosh, to expect to outperform every year is a big statement. I mean, there are very, very, very successful, brilliant investors who don't outperform every year. I think if we looked at it, we'd probably find Buffett doesn't outperform every year, and he's the best. I don't think in terms of distinct calendar periods necessarily. I'm just trying to buy companies that I'm very happy holding. Even if circumstances change, I go into them with the mindset that I think they're sensible companies to hold if times get rough or if times get good. So I certainly want to make money with every investment we make. That's why we do it. Can I say that we're short-term in that mentality? No, we're not really short-term, but I certainly expect those to deliver for me over a reasonable investment horizon. Otherwise, we wouldn't bother.
Fantastic. Well, I think that's about it. If there's any other questions we haven't answered, we'll try and get back to you with the answers. But thank you very much indeed, Alexander and Luca. Thank you all very much for joining us, those of us who are listening. The next session is starting at 1 p.m, which is Martin Curry Global Portfolio. So thank you so much, everyone. And thank you, Alexander and Luca. Goodbye.